Roland, man, thank you so much for joining me. This is a pretty cool opportunity to lift something up that I've been always wanting to do, and so we started this podcast, Dirt to Deals, and the whole purpose of this podcast is to kind of bring everybody involved. From the builders to the agents to appraisers like myself, to the mortgage experts like you and title experts. I just want to encompass everybody and kind of go more in depth of what it's like to to make money in the real estate world. And there's money made in the dirt, and there's money made in the resale, for even attorneys. A lot of attorneys, financial planners. So we're just going to take this podcast. This is our first episode. So Roland, thank you so much for being a part of it and being willing and being my little guinea pig. So first of
Hey,
all,
you bet, Gary. Hey, and,
yeah,
and let
hey,
me just say, I am extremely honored to be the first guest on the Dirt to Deals. I love the name of that. I think it's great. Um, you know, there's so many different nuances of dirt to deals. I mean, talking about, from a builder aspect, they're literally taking dirt to deals.
right.
And even in, the resale world, there's dirt in, buyers that are having a hard time, and I've been known as a fix it guy, and I'll get a call that says, "Hey, we're having this deal fall through escrow. Is there anything you can do to save the loan?" They're not able to, they were told their debt to income ratio is too high. They're scrambling to get a co-borrower. They just found out this, a week before closing, and can we turn that, can you save the deal? And so
Yeah,
I
yeah.
love the name Dirt to Deal.
Thanks, buddy.
I think it's going to be, I just think the name alone is going to blow up. But with you doing it, it's an honor to be a guest on your first show, man. I'll never
Thanks,
forget.
buddy. Thank you. Yeah. So Roland, tell me, how did you end up in this? I find that most people stumble into this. So a lot of appraisers I know, they didn't have the idea in their mind that they wanted to be an appraiser or the mortgage guy. So I'd be curious to find out, was it your family that got you involved, or did you know right away when you were young and you kissed your wife for the first time that you're like, I'm going to be this mortgage guy? Tell us how you got to the point
You
you're at.
know, that's funny, but you told me we were doing a short podcast, so I don't know how deep I can get into that, but I'm not much of a talker, so I'm going to try to make it quick. I turned 48 years old tomorrow,
Okay.
and I got into this business in October of 2020, excuse me, 2002. So
Okay.
I'm going on to my 23rd year of originating loans. And prior to that, as a young 20-year-old out of college, I was running a call center for MCI WorldCom. And if you
Okay.
remember in the MCI AT&T wars, it's like
Yeah.
the Burger King and McDonald's of the telecommunications and the long distance phone carriers. And it was a big deal back in the late 90s, early 2000s. And I got a job on there, and I excelled at it because I could talk and, working the phones, and, moved up the ranks quickly, became a supervisor, became a night shift manager. And, I found myself at 22 years old running 5 teams on a night shift in
Wow.
Ohio.
Wow.
And one of my mentors, when I was running that, was running one of the other teams. There was 2 teams on the night shift, so we would battle each other. And he was about 10 years my senior, and we ended up both randomly from Ohio at the center that we were opening up with the team of people, our old bosses from Iowa, and promoted us to go out there to start the call center and do all this stuff. We knew that we weren't, it only took me a year, because that's how long I had to be there to not repay my relo money that they paid me to move there,
Oh, okay.
to find out that, uh, you know, Eastern Ohio was not where I wanted to live my life.
All right.
And
All right.
so I wanted to be back to the West Coast. I had actually gone from Iowa to California. I went from Huntington Beach, California to Youngstown, Ohio, to run this night
Ooh.
shift and be a part of the opening of the newest branch of this company, and it was a culture shock.
Yeah,
I
that's
went
for
from
sure. That's two different
350, yeah,
two
I
different
counted. It was
extremes.
353 steps from my front door of my apartment that I had to the sand on low tide. And then I was out of money. I was living in, working in Santa Ana, living in Huntington Beach with a $23,000 base salary and in major accounts as a 22-year-old kid. And my old boss from the job I had when I was in college said, "Hey, Roland, I want you to come out and run my night shift." And I was like, "Oh,
Wow.
geez." So anyway, I go out there. A year later, I said, "I got to go back to California. I got to get to the beach." And she said, "Well, we don't have, I said, "I love what I do. I mean, running night shift telemarketers, this is fun,
Yeah.
And she said, "Well, we don't have anything in California. The farthest west we go is like Albuquerque or Phoenix." So I said, "Well,
Wow.
you know, I I think I got a B plus in geography, and Phoenix is closer to the beach than Albuquerque,
Yeah.
so I'll take that." And then 6 months after I moved to Phoenix, in February 2022, with my girlfriend, who's now my wife,
Nice.
the telecommunications business went down. Nobody's dialing long distance because cell phones were
Yeah.
created. And
Yeah.
so my mentor, in a way, in the sales world, who was 10 years older than me, used to live in California also, used to be in the mortgage business back in the early 90s and then went into telecom. He came out to Phoenix also and he said, "Roland, we're out of here. This place is going down in flames and we're going to open a mortgage company." And I said,
Wow.
"Sounds great." So I went and got trained up, and he got a job as a branch manager at a mortgage brokerage. There was a ad in the paper, and he hired me on obviously as a loan officer. So I kind of learned the books. And 6 months into working at that company, we split off, incorporated our own mortgage company, built that.
What?
We had an office. We had in upwards of 25 to 30 employees with two processors and 7 to 10 appointment setters and a whole room of telemarketers because that's what our background was. And we were calling subprime refinance deals, and every single deal that came out of the telemarketing room of people that showed interest would then go to an appointment center. Then the appointment
Okay.
center would talk to the people and find out the people that actually have a need or own a house and need to refinance or drowning in debt. And then all of those deals would come onto my desk, and I would just sit there and close every single deal. And we were doing 60 to 70 loans a month. And
Wow.
over the years, I was running I was managing the processing, I was managing the telemarketing room, I was managing all the appointment setters, I was closing every deal in the office. My business partner was having some life struggles, so he was pretty much absent in the office. So I
Okay.
all of a sudden, 6 months after moving to Phoenix, as a night shift call center manager, I'm running a mortgage company
Oh, it's
that's closing 60 deals a month,
thrown into the
and
fire.
it was, but I was, 20, 23, 24 years old. So, it was 80 hour a week wasn't a big deal. Like
Right.
that's what I wanted to do. But I fell in love with the actual phone calls when I could hear the client on the phone
Sure.
and I was helping them. And they would
Yeah.
thank me because they didn't know what to do. They didn't know how to access equity. They didn't know how to help their kid buy a house. They had
Sure.
no idea what was going on because what I've found in the last 22 years is that there's been a big veil put over the mortgage business and the real estate side. And most people, first time home buyers, all the way to brain surgeons. I did a loan just recently, earlier this year. The guy's, making $90,000 a month doing brain surgery, and
Yeah.
he didn't know anything at all about the mortgage process. And so
No,
there was a
and
real
that
need there.
that's exactly why I wanted to bring you on because I really feel that this next shift that we're running into, um, guys like you that are creative and know how to do it and do it right, and then not just do it, but educate the client so that they're well informed to make that next step. That's huge. And that goes to why this podcast could be huge, because as an appraiser, I have no idea what you guys do. I literally think that you guys just shop rates and try to connect A to B and close the deal. But as I've got to know you and talk to other people, there's a whole science. And it's not just closing deals. It's not just collecting your percentage and moving on to the next transaction. Because everybody has a story. Everybody's in a, like you said, the brain surgeon who makes great money, or the guy who's drowning in debt and is looking for a lifeline,
Yeah,
and people just
absolutely.
don't know, right?
And that's I have found lately in my career, 22 some years doing this later, that one of my favorite parts about it is being the educator.
Yeah.
I was raised by teachers. I mean, generations of my grandma was a teacher, my great grandma was a teacher, my mom was a teacher, my dad was a biology teacher, and ended up being a dean of students and a vice principal of a high school before retirement. And
Oh, it's in your blood.
I love to educate people. And when the crash happened in 2008, when the whole world crashed, the House of Cards, you can watch the movie Big Short and learn all about it. It was the crash of I call it the fake loan business, where literally all you needed was a driver's license and a credit score,
Yeah.
and
Right.
they were funding 100% loan to value, no verification of income, no down payment, no skin in the game. Just go out and hold out your credit card, or I mean your driver's license, and you buy a house. And
Yeah.
it was wild, what was going on. I still remember to this day, and he's still a friend of mine. He a lender rep with a bank I had right when this kind of was starting. When I was running my office before the crash, I submitted a loan, and I submitted 2 years of tax returns and calculated the income, and I had bank statements and for this guy buying a house. He qualified. He was a very clean borrower. And I
Hmm.
remember the account executive of the bank that I sent it to, and he calls me and says, "Roland, what are you doing?" I said, "What do you mean?" I said, "I just submitted a great loan to you. It's a max conventional 419, which is what the max conventional loan was back then. Today it's
Okay.
806, so it's grown." He said, "What are you doing?" He said, "You submitted a file with all of these tax returns and bank statements and business documents." He said, "It's the same rate on a no doc loan, which means whether or not you put any of this in or submit any of it, it's the same product for the borrower." So I said, "Well, what do you
Wow.
want me to do?" He said, "I want you to resubmit the loan. I want you to take out all of the tax returns, take out all the bank statements, delete everything in the application in terms of
Wow.
assets, employment, and income, and resubmit a blank application with no documents, because the borrower is getting the same rate and the same deal." And I said, "Well, that makes sense, I mean, let's." And so then I was like, "Man, that is wild." And that's what people started funding on. And then all of a sudden,
Yeah.
surprise, surprise, those people weren't able to refinance because they didn't actually have jobs. They didn't have, they couldn't make their payments. So the world crashes. My business partner and I had two totally different ideas of what to do when the real estate market crashes. And so we split our ways, we went our own ways, and I
Okay.
went into my home office and just to figure things out, like what are we going to do? It's March of 2007. The stock market's
Whoa.
going nuts. The real
Yeah.
estate market is crashing. I love what I do. Um, what am I going to do now? And I just started calling old clients and building relationships with people. And I found, like, man, I have so much time now to spend with the clients because I'm not managing 40 employees in an office and running,
Right.
doing pipeline meetings and training appointment setters and telemarketers and all this. I can use what I know and just help people. And so I built a word of mouth business just on that. And that is what today, I'm still a broker. I was with the bank for a while because you kind of had to be after the crash in 2010.
Okay.
But now I went back to the broker platform because the broker platform in the mortgage world, and we'll get into the differences, but the broker platform is where you can obtain the lowest rates, lowest fees, close fast, and do it based on just Fannie and Freddie's guidelines, which keeps the
Okay.
paperwork down. And I want to get into that because when I'm educating people, I thought it would be cool for this call to to let's lift the veil on the mortgage business. Like it's not a
Sure.
mystery. There's no secret. It's really actually pretty cut and dry. So
All right. Yeah.
that's what we'll get
Like,
into.
open it up. Like if you're a first time home buyer, let's take a couple of stabs. Like first time home buyer, then maybe like somebody like I really feel like currently in this market because when we had the rates so low and people locked in under 3%, they are scared to leave that, right? But they're
Well,
being
100%.
consumed by credit card debt because they've had to utilize that because they don't want to refi. And A, it's hard to get a
That's a
refi, and
that's a
B,
good point.
they don't want to lose that 3%, and but yet they're hoping things are going to change, so they put it on the credit card, hoping that things will get better. And we're almost 3 years into this stagflation type of scenario. And so I
Well,
think that
yeah.
would be something for you to talk about. So, yeah, please open up about what does a first time home buyer, what does it realistically need to know on your end of the ball, or your end of the field? What do they need to know to move forward?
Well, I think one of the biggest concerns with a lot of first-time homebuyers that I talk to is that they're apprehensive about buying a house because they heard the stories of their parents or they heard the stories. Maybe they're trying to re-enter the market and they remember 2008 through
Mm,
2011 and they
yeah,
remember
right,
buying a house. They remember buying a house for $400,000 and then
right,
a year and a half later it's worth 250 and they're
right.
$150,000 upside down. And so they're like, well, I don't know. I know that you can. People have lost their shorts, but I educate people that that was a totally different time when that happened. That was a no doc blank application. It should have never happened. Nobody ever went to jail for it. And it's pretty well documented in a couple of really good movies. If you want to learn about what happened, there's a documentary called Inside Job that really, really does it. The Hollywood version is called Big Short. It's pretty
Yeah,
much the same. It's the same deal. It's the same
yeah. A little
events,
more
but
fluff.
Inside Job is pretty eye opening. But anyway, a lot of people are concerned about that. So their biggest concern is what if home prices just plummet, and they kind of solved that after it was the Obama administration that came in and created the CFPB, and they created it was out of the Dodd-Frank Act, which
Yeah.
created the ATR, they call it, the ability to
Okay.
repay. And so now every loan since that whole crash is based on a minimum down payment. It's based on people qualifying for payments that they can prove that they can pay through their pay stubs or
Okay.
their jobs. So housing now over the last 15 years has been propped up by people that can actually pay the bills and it's not garbage. What
Okay.
happened in COVID was that when COVID happened and the world was crashing again financially, housing didn't because the Fed stepped in. They cut the rates to zero. Rates went from in the five-ish neighborhood percent down to many times under 3%, but it's three
Yeah.
percent, the 2.5, and so everybody that owned a home at that time refinanced their mortgage,
Of
right? Like if you're
course.
going to cut
Yeah.
your payment in
That
half,
was that
every
was my
single
best
person
season.
refi.
I did so many
Oh,
homes
it's
during
just
that time.
it was the biggest refi boom of our lifetime,
Yeah.
and
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 it
it
was
was
it
also
was
a purchase boom too.
and I knew something was different too because we're lucky enough to live in Scottsdale, and a lot of the big money people were refinancing their homes.
Every
So
single
here I
person that
am.
had a mortgage refinanced,
Yeah, I was
and
I mean, I was appraising $5 million homes like as if it was just a typical day at work. You know what I mean?
well, if
And
you
that
had a
told
loan on your house, you were, and a lot of the people, the high net worth people, were they didn't have a loan they were paying off. Maybe they were free and clear
they
on that
just
five
want
million
money,
dollar second home.
cheap
They
money.
were just if they can get $2 million at 3% and put it into something that can make
Tesla
10 to
stock.
15%. I mean,
Yeah.
it's a no-brainer. So
Yeah.
that's exactly though what has kept, because then in 2022, March of 2022, when all of a sudden, you remember, so the aftermath of COVID was
Oh, yeah.
supply chain. You remember supply chain?
Yeah.
Like lumber tripled in price,
Yep.
and
Yep.
all this stuff was going on. Gasoline was going up, and because what was it? The Suez Canal was blocked, and you would see these things, and nobody could get the stuff off of the
Right.
crates, and from China. It was this wild stuff, and so inflation went through the roof because
Yeah.
all this free money was out there. And so they
Yep.
had to, real estate was just going nuts.
Yeah.
Rates went in March of 2022, rates went from 3% to 6.5% in like 90 days.
Yeah. It
And
was a
it
blink of,
was,
I mean, talk about feeling the pinch as an appraiser.
it was
Um,
it was the opposite of the COVID crash in rates, because all of a
yes.
sudden, overnight, nobody's refinancing.
Right.
Because there's nobody,
It was
everybody
done.
already got their 3%. They're
It
no
was
longer
done.
going to get nobody's going to go from 3 to 6 to pay off a credit card.
A hundred
So it
percent.
was just over.
Yeah.
And it was in the 6%. And then everybody's like, well, don't worry, it's just bouncing up a little bit. Now it'll come back down. And then 2023, they continued to go up. And
Yeah.
inflation continued to increase, and the rates were creeping closer to 6.5, and then high sixes, and then don't worry, rates are coming down, and then all of a sudden 2024, like don't worry, this year they're coming down, and then got up to 7%, 7.5%, seven. Some people were calling for 8s and 9s on conventional loans, so
Right.
people were flipping
Right.
out a little bit, and they kind of put the brakes on buying. Nobody was selling, because if you owned a house at 3%, you're not going to sell that and buy
Where are you
something
going to
else, so you're
go?
holding on. And that
Yeah.
that kept inventory artificially low. So
Right.
there's no houses on the market. But
Yeah.
people are still living life, and new home buyers coming in, and people want to buy a house. I mean, buying a house is a part of the American dream. You own your
Right.
own property. You're no longer renting, because when you're renting a house, you're just paying somebody else's mortgage. And that's one thing I tell people. They're like, I'm nervous. I've never had a mortgage. And I say, well, are you renting a house right now? And they say, well, yeah, we've been renting this house for 5 years. I said, well, you're paying a mortgage.
Yeah.
It's just not yours. You're building
Right.
somebody else's equity.
Right.
So, but they were apprehensive, because they were like, well, I don't know if I want to buy, because, I don't want the house to crash like it did. But everybody was buying based on their merit to pay the bill and their minimum down payment, which has been put forth by Fannie Mae and Freddie Mac. And so now we're at the point where rates are starting to come down a little bit.
Yeah.
We're in the sixes. I'm no longer,
Yeah.
unless it's an
We
investment
just dipped
property.
today. Did we dip today below 7?
Today was really good. I'm locking a lot of people with a 6 point something. It's high sixes, but
Yeah.
we're out of the mid sevens.
Yeah.
And now the feds are talking about maybe starting to decrease the Fed rate, which is not the same as mortgage rates. It's not directly tied, but
Right.
it does have an effect. And so over the next couple of years, rates are going to be falling. And so the people now are like, okay, well, I talk to so many people that are on the fence. They want to own a home, but they don't want to buy, because they got parents in their ear or whatever. They've got people, well,
Sure.
don't buy when it's a 7%.
Sure.
Well, if you're waiting to purchase, that's when COVID rates dropped to 3. That's when housing took that huge jump. I mean, housing went on fire, because lower rates make it more affordable. You get more buyers, more people can afford the payment at the lower rate.
Yeah.
So then prices go up, because now you've got competition on the buyer side. And so that is what's going to start happening coming forward. So we're in the tail end of the highest rates we've seen in the last 10 years. So if you buy now, then you can always
You got
just
refinance room.
you refi later, but you're buying at the price now. If you wait for the rate to be lower,
Yeah.
and you wait for the rates to build into the coming increased real estate value, then you're missing out on the equity. You might have the low rate, but you're buying at a higher price, so the payment's the same as if you buy now, but you
Right.
lose the equity, and you're still going to be in the same payment anyway. So I'm educating people that don't worry about what had happened, because today's mortgages are all built on the ability to repay, and they're scrutinized. And when I talk to a first-time home buyer, the very first question I ask them, and I ask this to everybody, whether they're a first-time home buyer or not, but I always gauge people's knowledge of, have you ever heard of Fannie Mae and Freddie Mac?
Hmm.
Because if you understand who Fannie Mae and Freddie Mac are, it takes the veil off of the whole industry, and it starts to unlock these mysteries. And still today, most banks you go and talk to, it's they say, fill out this application, submit to me every single piece of financial document you've ever heard of in your entire life. You get the guys, well, what do you need now? My DNA?
Yeah.
It's like
Right.
all this paperwork, and then you sit around and wait, and you're calling the guy, hey, what do I qualify for? What do I qualify for? Do we have good news? Am I qualified? Like, what's going on? And
Right.
they're left in the dark on it. And then the
Yeah.
person finally calls back and they say, well, we have your application, we have all your paperwork, and you qualify for $400,000.
Yeah.
And the payment's this. And there's no talk of what what makes you qualify for that. Like, why do you qualify for that? How do you qualify for that? What are you qualifying for? Like, what goes into it? What is that
Right.
payment? Why are there other loan programs? Is there anything else we can look at? So there's been this big mystery, and I think some lenders, they like that mystery because it makes them feel maybe sort of superior, that they're holding all the cards and the secrets, and that they can, be uh, the know-all, end-all wizard behind the cape, and the Wizard of Oz, I call it, and keep that mystery going,
Yeah.
so that people are on their knees going, oh, what am I qualified? Am I? So what I like to do is just roll out to people, like, what are they looking for? What
Right.
makes a loan qualification? And to understand loan qualification guidelines, you have to understand who Fannie Mae and Freddie Mac are. You have to understand what FHA is and VA. So I'll ask people, have you ever heard of Fannie Mae and Freddie Mac and
Yeah.
FHA and VA? Have you ever heard of debt to income ratio? Have you ever heard of loan to value? Have you ever heard of reserves? And if we take all those things that I just mentioned and we put it on a scale of 1 to 10, 1 being I've heard the words, but I don't know anything that they mean. And 10 being, I'm a fully astute student in all that. I know all of the Fannie Mae guidelines and Freddie Mac guidelines, and I understand what automated underwriting systems are. And I just want to see what I can, what can you do for me? Nobody's ever a 10. And most people,
Roland, you bring up a great point because, a lot of the people, as I walk into their homes to do an appraisal, they think I'm the home inspector, and they don't have the education to know the two differences. And I'm like, oh, no, no, I don't find the problems in the house. I just find the value of the home. And then, like, and that's kind of good and stuff. But I think you're right, and it's amazing how this industry does not educate people on one of the largest loans they're ever going to hold in their lifetime.
right.
It's all about quicken the deal, make it slam dunk, let's move forward, and
Well, and they want to
I
close the.
appreciate you expanding on this because I think as people can stumble across this and learn about this, it will educate them much better to be prepared for their next big purchase.
Well, and I think one of the problems is that, um, you know they're going in, and they're always uh, kind of wondering in the back of their head if there is another loan that's better, like
Right.
what should I be doing, like who is this guy, and am I doing the right thing? And they're nervous, right? So the
100%.
home buying process is a very stressful, full of
Yeah.
anxiety. And most of that anxiety, unless you're a cash buyer and you're filthy, you got all this money and you're just paying cash, it, those are
That's
different
a different
problems.
world.
But
Yeah.
when you're getting financed, like they're nervous about it, and because the whole deal, whether or not they actually get the house that they've walked into, made an offer for, they see the place, they love the place, they picture their lives in the place, they've already got the rooms picked out for the kids, they already
Yeah.
know where the TV's going, they're already planning their housewarming party, and now everything is, they're freaking out, hoping that that loan goes through. And most of these people that are doing loans out there, a lot of these lenders are, they've got a, they expect 90 to 95% close ratio, and they take in
Yeah.
these applications, and if 90% of them close, they're doing great. Well, to me, that's 10% of people devastated in the
Sure.
process. And
Sure.
and that is not acceptable.
Yeah.
Because when things do go south in a mortgage loan, in a real estate transaction, it typically comes in the form of, hey, the realtor saying, hey, have you heard from your lender? What's going on with your loan? Are they going to be ready to close? And they say, well, I don't know. I haven't talked to out. And then they call and they say, hey, is everything okay with the deal? And then in those 10%, the people call back and say, well, there's an issue in underwriting, and the debt to income ratio, they're saying, and they blame it on, they push it all on the underwriter. The underwriter is saying that your debt to income ratio is too high, and I guess they didn't like the XYZ, and we're going to either need more down payment, or find a way to pay off your car, or maybe you can get a co-borrower. And it's like, I got to close in a week and a half. And now you're telling me that I got to
Right.
pay my
Right.
car off if I want this
Yeah.
house that I've shown it to everybody. I've driven by with all my friends and family, and we're already
Right.
planning. I got the mover scheduled. I got
Yeah.
all this stuff going on in my life. And now with a week and a half left, you're telling me that I got to get a
Yeah.
co-borrower? Like, what?
Yeah.
And then the people are left in this mystery, like, what happened? Like, I guess it didn't. And then their friends and family, hey, so what's going on? What do they tell you? Well, I don't know. They said it was just something about debt to income ratio, and something about the debt to income ratio was too high. I don't really know what they're talking about, but they need me to get. And so that's where I say, first of all, you should know exactly what they're talking about.
Yeah.
That should not come up with a week and a half left. And because debt to income ratio is a very finite, objective, calculated, mathematical equation that's based on qualifying. Like, they should
Sure.
have known. They should have known whatever came up. They should have known that when you went to them for the first day to say, I want to buy a house and get pre-qualified. What can I buy? Like, where's my lending capability? And if they're not, taking a bird's eye view over the business, and people that are not educated with who Fannie Mae and Freddie Mac are, and what the
Yeah.
automated underwriting software is by Fannie Mae and Freddie Mac, they get blindsided by this. So maybe we should dive into that, and I can do it as quick as I can, or maybe we need to
Yeah.
do
Go
another
ahead.
podcast to get
The
into it.
room is yours.
But
Let's go.
I, I explain to people that to understand mortgage lending, you got to understand Fannie and Freddie. And
All
Fannie
right.
Mae and Freddie Mac are mortgage banks, and they were created in the 60s and 70s in order to free up to buy loans from banks so that banks had more money to give to more people to buy houses. So
Okay.
every single loan that you get, every mortgage that anybody gets on a conventional side, now there's a lot of non-QM. We'll do another podcast about, alternative loans and non-QM
Sure.
stuff. But the standard mortgages that you get, you're going to be in four categories. It's going to be a conforming conventional loan, which
Hmm.
adheres to Fannie Mae and Freddie Mac's guidelines, a VA loan, or an FHA loan, or a USDA loan.
Mm.
So I'll ask people, a USDA loan is the Department of Agriculture. Those are really good loans insured by the USDA, and they're typically in ultra rural areas. If you're buying
Right.
a house in Phoenix, or you're buying a house in Memphis or Nashville or any metropolitan area, it's not going to be in a USDA area. So most
Right.
people are not going to fall in that. And then the very next question I ask is, are you a veteran? Did you serve in the military? And if they did, then we're going to go straight to VA underwriting because it's the cheapest, best loan available. If they didn't, well, then they're not getting a VA loan if you're not a veteran. So that eliminates that. So then it really comes down to FHA or conventional. And so what is an FHA or conventional loan? Well, Fannie Mae and Freddie Mac. So if you take any mortgage that's given out by a bank, and you can either go to a big box bank that I call like a Wells Fargo or a Chase, Bank of America, and get a mortgage from them. You would never do that. I would never wish that on anybody because you're dealing with an hourly paid cubicle
Right.
warrior, I call them.
Right.
They're
Right.
not really that invested. Or you go to a mortgage bank like a Fairway Lending or a Rocket Mortgage or a VIP Lending or one of those
Right.
places, and they give mortgage loans. They're the bank that gives the loan. And if you go to Fairway, you get a loan from Fairway. If Fairway can't close your loan because they have their own little rules on top of Fannie Mae and Freddie Mac's rules, then you're not going to get a loan through Fairway. And then you're going to be
Right.
back on the street trying to find, or you go to a broker like myself that can know which lenders out of 250 lenders that hundreds of lenders that are out there, which ones will give you the mortgage loan and all that. No matter who you go to, whichever avenue that you get a mortgage through, that mortgage has to adhere to the underwriting guidelines that are written by Fannie Mae and Freddie Mac for a
Right.
conventional loan.
Right.
Because all of those guys, all those lenders, whether it's a brokered lender, a direct lender, or a big box lender, they're doing a conventional mortgage loan, and
Hmm.
they're expecting Fannie Mae or Freddie Mac to buy that loan so they get the
Right.
money back so they can give more loans out. And so
Right.
Fannie Mae and Freddie Mac, I call them the king and queen of all things mortgages in our country. They run the world in
Yep.
mortgage lending.
Yeah.
And they're kind of like Burger King and McDonald's. It's the same taste, it's just different packaging. So they have the
Yeah.
same rules. It's conventional rules. It's all very cut and dry. There's not a lot of gray area, although there's once in a while you can get an exception to one little minor detailed rule. But if you printed up a PDF of Fannie Mae and Freddie Mac's conventional mortgage underwriting guidelines,
Yeah.
and you
It's
go
almost.
and you pull up their
Yeah. It's
cell,
almost the same.
it's 1,300 pages long.
Yeah.
And so if you go and print, so the same bank will give you a conventional loan, or they'll give you an FHA loan, or they'll give you a VA loan, or whatever. And the only difference between an FHA, conventional, and VA loan is who insures the loan. So the
Right.
loan that you get has to be insured in case you default. And if you do default, and the lender then, I always joke with people like mortgage lending can be one piece of paper. I'm giving you money for the house, and if you don't pay the payment, I'm taking your house. Like
Right.
that's as simple as really as it is. But in that scenario where the bank has to take the house because you failed to make the payments, they're going to go ahead and sell that house. And maybe you've destroyed the house. And maybe they don't sell the house for as much as you owe on the house. So they're underwater on it. Who pays the bank the money that they lose in that scenario? And that's the insurer of the loan. The FHA, which is the Federal Housing Authority, insures FHA loans. So if you get and so because they're the ones insuring it, they get to write the rules on FHA loans. So they've bent the rules a little bit, and they allow a little higher debt to income ratio, which we'll talk about. The VA insures their veterans loans. So if a bank
Yeah.
gives a VA loan based on the VA guidelines, they'll say, hey, if you lose any money on that, we got you. We're going to cover. It's like gap
Yep.
coverage on the auto. And then so if you are putting less than 20% down on a Fannie Mae or a conventional loan through that gets, bought by Fannie Mae or Freddie Mac, you have to pay private mortgage insurance. So there's a private mortgage insurance company that insures that loan. Unless you put 20% down, then you're not required to pay for any of the mortgage insurance
And
because
that's
they figure
PMI
this
for
guy's
the
coming
average
out.
person.
That's PMI, private mortgage insurance. And they're coming coming out, they're thinking these people are coming out with a chunk of cash. They're not walking on that. They're going to make the payment. And even if they do struggle or they lose their job and they can't make the payment, they're just going to sell the house because they got the equity and we'll get our money. We're not worried about it. We don't require.
Right.
On an FHA loan, it doesn't matter how much you put down. You could borrow 10% of the purchase price and put 90% down. You're paying the FHA or mortgage insurance premium. They call it MIP. It's the same thing as PMI, only it's the government's version of it, which is what makes VA loans so great because they don't require any monthly mortgage insurance. They don't require you to pay for it. But here's the real kicker. Fannie Mae and Freddie Mac, they each have their own proprietary underwriting software. And they call it AUS, which stands for Automated Underwriting Software.
Yeah.
And any loan that gets funded by any bank has to have an automated underwriting software approval through either Fannie Mae's software or Freddie Mac's software. Fannie Mae's software is called Desktop Underwriting. They call it DU. Freddie Mac's software is called Loan Processor Assist, or they call it LPA. So you have to have an LPA or a DU software, automated software approval, and it is nationwide, universal. No loan gets closed without an automated underwriting software through Fannie Mae and Freddie Mac's automated underwriting proprietary software. And that's the whole deal. And Fannie Mae and Freddie Mac are such the king and queen of everything mortgages in our country that they actually have the algorithms of the FHA guidelines and the VA guidelines built into their system. So even if you're doing a government insured loan, it also has to have a Fannie Mae or a Freddie Mac automated underwriting approval. And so then we get into once you can grasp that and you realize that the whole secret of the mortgage business is having an automated software approval through Fannie Mae and Freddie Mac. And then I get in with the people and explain to them what needs to be in the file to get the automated approval. And that all comes down to three things. It's a three-pronged approach. You have income, credit, and assets. And on the credit side, there are certain guidelines, whether it's a conventional loan, FHA loan, or VA loan, of what your credit needs to be, what's on your credit, how long major derogatories have been, like a bankruptcy or a foreclosure, or if you have delinquencies on federal debt. For example, FHA will give you a loan 2 years after a bankruptcy. Conventional guidelines, you have to wait 4 years after a bankruptcy. If you have a foreclosure on your record, you have to wait 7 years for a conventional loan to get approved.
Wow.
And you can do it 4 years on an FHA loan. So if you had a foreclosure and it was 5 years ago, you're not getting a conventional loan for 2 more years, because you're not going to get the automated underwriting approval because it sees that you had a foreclosure. And so it's going to say not approved, but you might get the FHA approval because that algorithm is built in to only read 4 years of a foreclosure. So
is it FHA only for first-time home buyers? So if I bought my second home, could I qualify for FHA?
Yeah, and that's one of the big misconceptions in the mortgage industry, especially with our baby boomer parents. I'll talk to a lot of people and they'll say, and I'll qualify them on a conventional loan, and they'll say, well, my mom told me I'm a first-time home buyer, I should be doing FHA. And I'm like, well, why would she say you should do FHA? Well, because she said I'm a first-time. So no, FHA insured loans are not restricted to first-time home buyers. The reason why it got that reputation is because prior to the conventional loan underwriting guidelines allowing as little as 5% down and 3% down for first-time home buyers, it used to be 20% down. So you thought, well, I can't do conventional because I don't have 20% down. You remember those days? And so FHA, their minimum down payment's 3.5% down. So if you didn't have a full 20 back before the rule changed with Fannie Mae and Freddie Mac,
you could always run FHA.
And typically first-time home buyers don't have a full 20% unless they were
Right.
incredible savers and they're entering the market. They just got a job out of college or whatever and they want to buy a house instead of paying rent. So FHA opened up a 3.5%, insured loan with 3.5% down. So most first-time home buyers 20 years ago, that was the option unless you had a full 20% down. But nowadays, if you are a first time home buyer and you can get a conventional loan, you can put as little as 3% down with Fannie Mae and Freddie Mac. However, one of the biggest differences is that the interest rate and the mortgage insurance rate of how much you have to pay in monthly mortgage insurance on the Fannie Mae Freddie Mac conventional side is all based on credit score. And
Wow.
there is a chart if we look up, and maybe sometime we can add a visual or something, but there's a loan level pricing adjustment matrix. And if you're the rows across the top are credit scores in 20-point increments. 780 is the cheapest rate you can get, and then 760, 740, 720, 700, 680, 660, 640. And once it gets down under 720, it gets expensive. Not because they
Wow.
charge you fees for being those credit scores. And what most lenders end up doing is the buyers, they've just got enough money for their down payment. They don't have the money for the extra
Right.
fees because of their credit. So they'll end up absorbing those fees into the rate,
Into the
which
loan.
raises the rates, which is why they say if your credit score is lower, the rates are higher. And
Yeah.
certain loan programs, like if you're buying an investment property, there's extra fees for investment properties. So
Right.
people will absorb those fees into the pricing, which makes the rate higher. On the FHA side, it's pass fail, man. If you're a 640, you get the same rate as the guy with the 800 credit score. So it doesn't
Interesting.
matter. It's you're either a 640 or you're not. And they can go down to 620 and 600 and some lenders 580, but that gets really pricey. And their mortgage insurance on an FHA insured loan is the same rate. It's point, if you're putting 3.5% down, it's 0.55%, just over 0.5% of your loan amount divided by 12. That's how you get the monthly mortgage insurance. That's the same rate for everybody. So you could have an 800 credit score, you're paying the same amount of mortgage insurance as the guy with the 640 credit score. In the
Wow.
conventional world, the 780 mark is where it doesn't matter if you're an 850. As long as you're over 780, you're getting the lowest rates. And the mortgage insurance at the high credit scores is a fraction of what FHA mortgage insurance is. And so
Interesting.
a big difference also is that FHA insured loans, they charge what's called a upfront funding fee. And it's 1.75% of what you borrow. So if you go and get a conventional loan and you put 3% down because you're a first time home buyer, you're borrowing 97% of your contract price of the house you're buying. And so your loan amount at when you close at the end of the day is going to be 97% because you put 3% down. On an
Sure.
FHA loan, you put 3.5% down. And so you would assume that you're borrowing 96.5%. But then what the FHA does on every single loan is they take 1.75% of the 96.5% and add it to the 96.5%
Wow.
and stack it on top. So a $400,000 FHA loan, now, if you're borrowing $400,000, you're really borrowing 407, and change. You're
Right.
walking away with a principal that's 1.75% higher than what you're actually borrowing. And what the FHA calls that is an upfront funding fee. And what I call that is the government equity stripping program, because that's what they're doing. I mean, the more you owe on your house, the less equity you have in the house. And
Right.
so I take people, first time homebuyers especially, if I can, to a conventional loan because there's no upfront funding fee stripping away their equity.
Sure.
Now, if
Sure.
they're a 640 and they want to put minimum down, that rate is going to be so high on the conventional loan and the mortgage insurance is going to be quadruple what FHA's
It
is.
doesn't make
So,
sense. Right.
so there's times where FHA is cheaper, but you only want to do an FHA loan if you have to. Because if you can qualify and you have really good credit, conventional is the way to go. But the point is, unless you have an automated underwriting approval through the automated underwriting system, you're not getting any of the loans. You have to have that
Yeah.
approval through the system. And what I tell people is that a lot of people in my business, I don't know if they're not allowed to or they're not trained on it, but they don't run that automated underwriting. They collect all your information, all your documents, they send it into the underwriter, and then the underwriter of the lender runs the automated underwriting system through Fannie Mae and Freddie Mac, and then they come back and say, well, after calculating your income, your debt to income ratio is it's higher than what it was on the application, and we've got some, well, Fannie Mae and Freddie Mac post very clearly exactly how they calculate every single type of income. There's pages of different income types that you wouldn't even believe. Whether you have the W-2 salary
Mhm.
employee, the hourly wage employee, the part-time hourly, the commission, the bonus, the
Yeah.
self-employed borrower, the 1099 borrower, the fixed income borrower, the rental income borrower. There's so many different types of income, and Fannie Mae and Freddie Mac and FHA and VA are very clear on how those income types are exactly calculated down to the dollar, because that's what matters. Because the most important part in getting that automated underwriting approval is passing your credit. The assets is easy. That's whether or not the money you're going to put down in the house is from an acceptable source. Has to come
Sure.
from a checking account or a gift. It can't be, gold bars in a safe. Like they don't recognize that as acceptable. But the
Okay.
biggest piece is the income. And what they do is they calculate your income by how they write it out in the guidelines. And your income, especially if you're self-employed, is not how much money you make. It's how much money Fannie Mae and Freddie Mac say you make, because then they take their calculation and they
Yeah.
calculate it on and by their guidelines, and then they take the annual income, they divide it by 12, and that's your monthly income. Then they take your monthly payments of your mortgage bill plus all your monthly payments on your credit report, car loans, student loans, minimum credit card payments. They don't care about insurances and utilities and stuff like that. Only what's on your credit report. They take all the minimum payments, they add it to what your mortgage payment's going to be with taxes and insurance. That's your debt. Then they divide that by your income. And if you're going to get a conventional loan, you have to be under 50% debt to income ratio on a monthly cash flow basis. If you're
Okay.
49.999, you pass. You're going to get the loan. If you're 50.001, you're not going to get the automated underwriting approval through Fannie Mae or Freddie Mac. You're not getting the loan. I mean, there's been times where I've called insurance agents to drop their annual insurance policy by $5 a year, to drop the payment by 50 cents, to get them to 49.999% debt to income ratio, to get an automatic underwriting approval. And the cool
Wow.
thing is that, most brokers like myself, I run the exact identical Fannie Mae and Freddie Mac automated underwriting software before I send it to the lender. So when we're submitting a loan to a lender, we're not, I hope it's
Hoping.
approved.
Yeah.
We know for a fact that we have the automated underwriting approval through Fannie Mae and Freddie Mac, and that underwriter at the lender I'm sending your loan to is going to run the exact identical same stuff. And if I calculated your income exactly adhering to Fannie Mae and Freddie Mac's rules of calculating income, then the underwriter that gets it is going to calculate to the dollar the exact same income, and we're not going to have debt to income ratios because we knew this before you made the offer on the house. And
Wow.
so what happens is most people is there when they're qualifying for a house is I'll calculate their debt to income ratio, and the biggest thing is I want to know how much I approve for. Well, you'll be approved at 49.999%. On FHA guideline is 57. So you can go to 56.999 FHA. I think they raised that a little bit because they're jacking you on the upfront funding fee, and they're
Sure.
adding higher mortgage insurance, so they're going to give you a little leeway there. But there's a finite number of what your debt to income ratio needs to be to get the loan. I'm most of the time, 80% of the time, I'll have somebody, maybe they have a $100,000 salary, so they make $8,300 a year once you take it down to the monthly, and maybe they have a $500 car payment. So half of $8,300 is 4,150. They got the $500 car payment. They qualify for a $3,600 mortgage. That puts them in at 49.999. And they say to me, I don't want a $3,500 mortgage payment. And I say, well, many times people qualify for more than what they would be willing to spend. So then it comes down to, let's reverse engineer your debt to income ratio, and let's find out what's your walk away monthly payment. Like, if that house is perfect but the payment's $3,700, I don't care how perfect it is, I'm not getting into a $3,700 payment. I don't want anything higher than $2,800 out here from a first time. And you say, okay, what if the payment's 2,850? Well, I mean, that'd be okay. Okay, well, what if it's 2,900? Well, I mean, if it's the right house, what is the payment have to be to make you walk away and not make an offer on the house? Like, what's your walk away payment?
Yeah.
Because at the end of the day, when you're buying a house, especially for first time home buyers, there's a lot of things involved. You get excited, you're buying a house, but
Yeah. A lot of emotions.
once you close and you take the pictures and you call your parents and you have your friends over, 45 days later after closing, mailman brings you your mortgage bill and you're going to have to pay the bill. So it's all about what that bill's going to be. Let's qualify around that, because most of the time people qualify for a much higher bill than they're going to feel comfortable for. But the point is that after you close, you got a mortgage bill to pay. And
Yeah.
so that's why I really like to focus on. That's why I love being a broker, because I know I'm always the lowest rate, because I know what people want. They want the lowest mortgage payment they can get on the house they want to buy, period. And that's what
Of
I
course.
want. When I buy a house, I want the lowest mortgage bill. And
Yeah.
so let's try to craft your approval. I may send you back to your realtor saying, "Hey, I'm approved to 600,000. I can buy a $600,000 house, but I don't want to be over 450 because I don't want my payment to be over 3150 or whatever that number
Sure.
is." But the bottom line is that we when we get to that number, we will know that we're going to have an automated underwriting approval through Fannie Mae and Freddie Mac. So when we get to once you get the contract, you already know what the payment's going to be at the end of the day. Like,
Hmm.
we've done all that. I have all your pay stubs and the things that I need to calculate your income. I've seen your credit. I know what's on there. There's no mystery. We're not going into underwriting hoping and praying that our loan gets approved. We're going into underwriting with the dominoes already set up as a formality to close on the house. And that takes the stress away. It takes the anxiety away, because they were educated up front of what an automated underwriting approval is, what it takes to get an automated underwriting approval, whether or not it's going to Fannie Mae or Freddie Mac or FHA or VA. They know that we've laid all the loan programs that are available to them on the table, and we've looked at them carefully as far as what's going to end you at the end of the day with the lowest mortgage payment, because
Yeah.
that's what people want. And and
Yeah.
and how can we get into that with paying the least amount of fees? Let's make it cheap. We're
Right.
going to make the cheapest loans that fit your budget, and you're not going to worry about whether or not it gets approved, because we put the underwriter hat on at the beginning of the process before you even look at a house and write an offer. And so half of my job is underwriting. So a
Yeah.
good loan officer,
Yeah.
they're going to underwrite up front. And then the other half of the job is the day trader. And that's going to be another podcast. We're not going to get into that now, but we're
Yeah.
going to
No.
talk about, we're going to lift the veil of mortgage pricing and how rates change and what affects the change in rates and what affects those different, why
Yeah.
do why does a 7% cost this, and what are the fees on that? And we'll do all the fees and that, because once I get somebody approved and they make an offer and they're in contract, then it comes down to, okay, now let's sharpen the pencil and really search the market, put our day trader hat on, and lock a rate when the price is low.
Yeah.
And then they can feel comfortable about that. And what you were saying earlier, Gary, I thought was a really good point. Like, the appraiser shows up and they're like, "What's going on?" That's another thing people aren't educated in, and it's really very simple. When you're buying a house, there's 4 times you're going to write a check. And you're going to write a check when you get into contract because you're going to have what's called earnest money. And
Yep.
that's like the money that you're putting down to hold your contract. And that's typically about 1% of the purchase price. And that does go to your 3% or 5% or
Right.
3.5% down payment. So that is part of your down payment. But that's the first check you write. The second check you write is once you drop your earnest money off, you got to get an inspector. That inspector is for you. It's not for the bank, but you got to pay him because you want to make sure that house doesn't have black mold, it doesn't have foundation issues,
Yep.
whether or not it needs a new roof. You got to make sure that you want to move forward with this $500,000 purchase. And then the
Sure.
third check you write is that once you've done your inspection, maybe you go back and get some credits or you get the seller to paint the railing or whatever it is. Then you're like, all right, we're moving forward. Then you write the check for the appraiser, and that's when Gary
Yep.
comes in because then
Yeah.
you get employed by the lenders and they call out to this random wheel called the AMC or the Appraisal Management
Yep.
Company, and then you get assigned the deal after the check is paid, and then you got your money and you go out, and that check is not for the buyer. That check is for the lender.
For the
So
lender. Yeah.
the first check you write is a down payment on your down payment. The
Yep.
second check you write is to make sure you want to buy the house and it's not going to fall down. The third
Yeah.
check you write is for the bank because the bank wants to know that the house is worth what you're
It's a good
paying.
deal.
And then the last check you write is finally on the day you close, you bring in the rest of your down payment and whatever closing costs you're responsible for. And when they know that, they're like, oh, well, then when the appraiser gets called, they're like, oh, yeah, well, I know that. Yeah, I did my inspection. Now it's the appraisal. And next
Yeah.
it's my third check to write. And I don't have to pay anything till we close. And it's just, it brings the stress level down of buying a house because there's plenty of stress in buying the house, furnishing it,
Yeah.
and moving, and all this stuff.
Yeah. Roland, as you really laid it out and really educated a lot, even myself, because I never really knew the full in depth of your side of the ball, and I think this is unique and it's important why it is for refinance buyers to educate themselves and not to be afraid to go to those smaller individual mom and pop shops because they're the ones that, like yourself, that really are going to steer that person the right way. Versus, I feel a lot of times like these bigger shops, they just got to hit a quota and they're just going to do whatever they got to do. And if it doesn't work, fine, goodbye. They're going to move on to the next deal. Where what you have, we're approaching an hour and 5 minutes. You have gone through a lot of detail that even myself, who've bought 3 or 4 homes and didn't even know all this stuff. Well, where could future people, buyers, refind? Where could they find your information? Do you have a website? Tell us a little bit
Yeah,
where they can find you.
I mean, they can hit me up on Instagram. It's called Roland Bennett Loans. About 2 years ago, or not 2 years ago, 20 years ago, I had this slogan because people would get into trouble with loans, and the bank would come back and say, "Sorry, you don't qualify," and maybe it's because the guy didn't know how to read a tax return, or they didn't know how to calculate income, or they didn't know what program they were selling, and so I would get called in, and I have a reputation in the business of being the fix-it guy, and so I'll come in and I'll fix the loan and find the lender that'll actually do that type of loan or whatever. And so there was a slogan that I used a long time ago that said, "When the banks don't loan, Roland Bennett loans." So instead of going to the bank, I know the back, I know the underwriting guidelines, and that's really what it takes to close loans is you got to know the guidelines, and that's a problem in the industry. Is so many you get all these
Right.
newbies in these big shops, and they're in the cubicles, and like you said, they got the quotas, and they're just they're given leads, and they got to burn and churn these leads, and Roland Bennett Loans is my Instagram handle. You can do that. You can RolandBennettLoans.com is my website. You can text me on my number at 602-513-3686. I mean, I'm direct access, but a good question to ask somebody that's doing your loan, you want to find out two things. Number one, are you a 100% commission? And so I am a 100% commission mortgage loan originator. I am licensed with Barrett Financial. Barrett Financial didn't used to be, but now they're the largest broker in the state of Arizona and becoming the largest broker nationwide. They're in 49 states. And it's kind of like Remax. You know, Remax is really, really big,
Yeah,
but there's good Remax agents and there's bad Remax agents.
sure.
And when you're dealing with a real estate agent, you're dealing with that person. You're dealing with that personality and their experience, and do they know the market and can they negotiate your contract? You're not dealing necessarily with Remax. They're just hanging their license with Remax. And the
Right.
mortgage business has turned into that.
Similar.
So I hang my licenses with Barrett Financial, but you deal with me. And I do not make one penny unless the loan closes. And so that's a really important thing because I'm motivated to close your loan. And I am motivated to not submit a loan that's not going to close. So I'm very careful on what I submit because that thing's got to close because it's your house. You know, the
And it's
last
also your
thing I do.
time. You know,
Yeah, well, the
you're
last
investing
thing
in it.
the worst call in the industry to make is sorry about the last 3.5 weeks, and I know you're supposed to close next Thursday, and you have your mover scheduled, but
Yeah,
we can't do your loan anymore. You don't qualify. It's like you don't
yeah,
qualify. Why not? Well, the
yeah.
underwriter said, there was something on your tax returns. Well, I gave you my tax returns 3 weeks, 4 weeks ago. Like,
Right,
why didn't
right,
you tell me that 4 weeks ago? You had the
right.
information. It's not new stuff. It's just uneducated people. And then the number two thing I would say is find out where people get where do they get their clients? And I get my clients for 20 years, 100% word of mouth. And so I'm a word of mouth referral guy. I have never purchased a lead from a
I was gonna
lead.
say you're not spending 20 grand a month in lead generations.
Well, but there's so many people that are, and they're spending a ton of
Yeah,
cash. They've got a room full of guys on the phone that don't
yep,
really know a lot. They just smile and dial, and they call all these leads, and they're just burning and churning, and they don't really care. And the guy that's buying the leads has all these kids that are calling and trying to close, and if they close 80% of them, great. You know, if 20%
yeah,
don't close, that's fine because they got so many of them going on, and I just think that's too big of a risk to be in that
yeah.
20% margin or 10% not closing margin because
Right.
you're never really getting all you're talking to is the guy that's going to take your application, then kick you off to somebody else. And so now somebody else comes in, they don't know your situation. You just spilt your guts for a guy that was simply setting an appointment for some other guy. And then that guy just is going to pass you into the processing world. And I think that's where people enjoy and appreciate the fact that I take that first call when you refer your kid to me to buy a house. I educate them up front. I talk about Fannie Mae and Freddie Mac. I run the automated underwriting. I pull the credit. I get their paperwork. I have a processor that helps me with the paperwork. But at the very end of the deal, I go over the closing statement, make sure you understand all the numbers before you go into the title company and sign the paper so there's no confusion, there's no stress, and you can focus all of your energy on your new life in your new house and what room your kid's going to have and where the baby's
Mm,
room's going to be and where you're going to put your couch and the stuff that people really care about when buying the house. And when they
awesome.
have the peace of mind that because I'm a broker, it's going to be the lowest rate available. There's going to be very little to many times zero in fees, so it's going to be cheap. And I'm going to tell you exactly what you're going to need paperwork wise up front. And I'm not going to nickel and dime you on the paperwork like everybody else does. These people you're talking about, they're trained to get every financial document known to man and just get it. And then if something comes up in underwriting and they ask for something else, you already have it. Great
Right.
concept because now you don't have to go back to the borrower to ask him for something else.
Exactly.
But in
Exactly.
my mind is, well, if 20% or 30% of the paperwork that you're getting up front isn't even required in the Fannie Mae and Freddie Mac automated underwriting guideline list of required documents to close the loan, why am I having you go through, why are you having to upload tax returns if I don't
Right.
need the tax returns to close the loan? And
Right.
I should know that because I'm running the automated underwriting approval the day I pull your credit. So
Yeah.
I only ask people for what I know is going to be needed. So it keeps the paperwork down. Let's just take the stress out of the
Makes you
mortgage.
feel trustworthy too. Nobody likes to just upload their personal information to just, and like you said, like you don't know if you're running that to somebody who is a skilled person like yourself or $18 an hour call center person that's just sucking this info. You have no idea. So, Roland, I just want to thank you so much. I think you highlighted a lot of great things that the audience can really take and really run and share. Not, I mean, even myself, I could share with other agents and other people that I come across, yourself, because in this, like again, this is one of the biggest purchase. People are doing things to make the next best move for their family or their dream or their retirement. And I think in this industry, people like yourself that want to serve a bigger purpose, not just to always close a deal, but really to make sure that that deal lives on more than just 2 3 years. That that the people are happy. That goes a lot further than just earning your commission check and
Well,
moving forward.
yeah, I mean, and I tell people that, you know, when you're a word of mouth advertiser, you have to do good by the
Yeah.
people. And if you
Right.
don't, they're gonna if you do good by somebody and you lay it all out and educate and they feel comfortable and they close and they're happy, they might tell one person.
A hundred percent.
If their loan gets screwed up and it gets hectic and it's a headache and they're scrambling
Oh,
on the day
20
before
people will know about
closing,
it before
20 people will know
before
about it.
lunch. Before
Yeah.
lunch.
But
Yeah.
and you know what I would love to do, Gary? I appreciate you having me on, and I'm excited for more of these. I would love if there is, or if, for the audience that's listening, I think we should dive into more detail of the differences between FHA, VA, and conventional in
Yeah.
terms of appraisals, because there's a lot of times where appraisals cause come up and
Yeah.
it plays a really big part in it. And I know, just knowing you personally, that you were one of the most knowledgeable appraisers I know, and it would be really cool to do a deep dive into appraisal differences so that
Yeah.
when people are looking at houses, maybe we can equip them, and especially you, with what should you be looking for to make sure that your deal's not going to fall south after the appraisal comes in.
Yeah. Yeah,
So
absolutely.
that'd be
Yeah,
fun to do.
we'll definitely have you on again, and we'll go into more deep dive because I think there's plenty of avenues that we could approach the and educate. That's the whole purpose of the Dirt to Deals. It's not just to come on here and talk about ourselves, but it's really to educate the masses. We want to educate everybody that's involved, because if you're an investor flipper, you need to know your market. You need to understand, are you catering to the first time home buyer? Well, these are the things that you're going to run into. So hearing someone like you
Yeah.
would help me to make a better investment choice in the future. You know what I mean? So yeah, so let's do it again. Thanks again, Roland, for being the episode number one for Dirt to Deals.
I
Looking forward
I
to many more of them, man.
very honored, man. And I appreciate what you're doing, and we've had talks, and what I love about what you explained to me about Dirt for Deals, is really how it's the educational piece, because what you're trying to give to people, is to help prepare them, and you're thinking of others,
Yeah,
instead of just a deal. And if more people in the industry would not worry about the commission dollars, but they would worry about the people that they're dealing with,
yeah,
then more buyers are going to have a better experience. And if more buyers have a better experience, they're going to tell other people, hey, this is buying a house is way easier than I thought. You should go
yeah,
buy a house. And it's going to
yeah.
create more activity. And so I love how you're always putting others before yourself, and praise God for that, man. I
Yeah,
appreciate you
praise
having me
God.
on.
Yeah. Awesome, brother. Many thank you. We'll catch you on the next run.
All right. Have a
All
great
right.
one.
See you, bud.